The longer you stay in the market, the better the growth opportunities that you give your investment over time, because the length of time in the market is one of the best predictors of the total performance of your portfolio. Hello, welcome to the video. My name is Romano Morin, and in today's class, we're going to be talking about how to make money with stocks. If today is your first time of joining the class, I'd like to specially welcome you, and if you're a returnee, welcome back. In our last class, we talked about the 10 guidelines and criteria in selecting stocks to buy and hold for long-term investment. If you missed that class, or if you would like to refresh your memory, I'm going to link it up here. I'm also going to link it at the end of this video so that you can watch the video later. So how do we make money with stocks? There are primarily two ways to make money with stocks. The first one is pretty simple. It's called capital gains. Let's say, for example, you bought a stock for $100 and you hold on to that stock for about 2 or 3 years. After year 3, let's say, for example, the stock is now worth $350, and then you decide to sell. The moment you sell the stock, you've earned yourself capital gain, and in this example, your capital gain is $250. That is $350 minus your initial $100 investment. Okay, and obviously minus any commission cost, which is usually very small, about maybe $5 to $10. The second way by which we make money with stocks is by what is called dividend. Dividend is a portion of the company's profit that is returned to shareholders. This is more like a thank you token for holding the stock. Let's take, for example, Apple. Last year, Apple made $64 billion in profit. That's a whole lot of money. So let's assume that Apple decides to take a portion of that profit and pays dividend to its shareholders. And let's assume that Apple decides to pay $2 dividend per share. That means that for every share of Apple you own, you're going to receive $2 income stream throughout the year. And this is completely independent of how the share price reacts. Whether the share goes up or down or sideways, it doesn't really matter. You're still going to get the $2 income stream every year. Dividend are an incentive that are paid to stockholders for holding the stock. Dividends are usually paid every quarter. So in this example, you're going to be paid 50 cents every quarter. There are 4 quarters in a year, and that's going to total $2. So if you own multiple shares, that means that you're going to receive multiple dividends. And this is a very underrated part of investing, because the more dividends you accumulate over time, the more the value of your portfolio grows. There are 2 important points about dividends. Number 1, not all companies pay dividend. For example, a lot of the big blue chip companies, they tend to pay dividend. And if you remember in our last class, we talked about established companies. These are companies that they've been in existence for such a long time. Some of them, they've been in existence for 50, 70, 100, 120 years. And because they've been able to generate revenue and profits consistently over a long period of time, they can afford to pay their shareholders dividend. Let's say, for example, the energy sector, the financial institutions like the big banks, they tend to pay dividend over time. But when you compare that to younger growth companies, usually growth companies, they don't pay any dividend because, as the name implies, they are still in their growth phase. And because of that, any profit that they make, which is usually very little at the initial stage, it's being reinvested into the company to make sure that the company succeeds and continues to expand and grow. Let's take, for example, Tesla. Tesla is still in its growth phase. So any profit that it makes, it's going to reinvest it into building more cars, building more factories like the gigafactories and the terafactories to make sure that it can continue to produce cars and greater growth for shareholders. It's also important to note that when you compare the price of a growth company to that of a dividend paying company, dividend paying companies, the price range, for example, for a year, it doesn't really vary that much. For example, you can look at Procter & Gamble. Maybe the price ranged from maybe 97 to about 1 or 150. But when you compare that to a growth company like Shopify, you can see a price range from maybe $300 to $1,005. There is a huge range when you compare the price for a growth company compared to an established company. And usually because of that price range, you tend to see that the big blue chip companies, because there's no much price growth, they tend to pay dividend to compensate their investors. Compare that to growth companies that they don't pay any dividend, but the stock price usually appreciate faster, again because these are growth companies. Number 2, dividends are not mandatory. It's completely at the company's discretion. So if a company decides to offer dividends, the company has the right to reduce, increase, or completely cut it out. And this doesn't usually happen, but maybe sometimes the economy is bad, the company is trying to stay competitive. The company might act in its own best interest, and because of that, the company might decide to reduce the dividend so that the company can still be functional and operate profitably. Nevertheless, it's important to know that dividend investing is very, very important, especially if you're someone that you're in your later phase of years and it's important to be receiving consistently the income, or if you're just somebody that you just want to be receiving income consistently irrespective of the phase of life that you are. Dividend investing is very, very key, especially when you factor in the accumulated effect of the dividend collected over a long period of time. This allows our portfolio to grow exponentially when you factor in the dividend that has been accumulated years after years after years after years. Now, for you to make money with stocks, it is important to stay invested and stay long term. On average, the stock market returns about 7 to 8% annually, which is far much better than what you can get at your local bank or in the bonds market. But oftentimes you wonder, why is it that a lot of investors fail to earn the 7 to 8% on average on their portfolio? Most of the time, a lot of investors don't stay long enough in the market. The key to making money in the stock market is remaining in the stock market, because the length of time in the market is one of the best predictors of your total performance of your portfolio. But unfortunately, a lot of investors, they tend to move in and out of the stock market, and they usually do this at the worst possible time, and because of these moves, they tend to miss out on the incredible growth opportunities that the stock market tends to offer, especially in terms of capital appreciation and also the dividend that you can accumulate over time. Essentially, the more time you stay invested in the market, the better the opportunities that you give your investment to grow over time. And as we said in previous classes, if you invest in solid companies, if you invest in companies that are changing our world, if you invest in companies that are stocks for the future, we expect that the price of the stock is going to be bullish over time, is going to go up over time, and because of that capital appreciation, the value of your portfolio is going to go up. And in addition, the more time in the market means that it allows you to collect dividend. That's if the company pays dividend. These two factors, like the capital gain and dividend, these are two pillars or ways to make money with stocks in the stock market. To make money with stocks, you gotta stay invested and stay long term, because the length of time in the market is one of the best predictors of the total performance of your portfolio. The longer you stay in the market, the better opportunities you give your investment to grow and multiply. And as we said in previous classes, it's just like an orange seed. The moment you plant the orange seed and you allow it to grow and bloom, that orange seed is going to become an orange fruit, an orange tree, and become an orchard. The same thing with money. But if you keep investing and you keep uprooting it, you planted an orange seed and you keep uprooting it every 2 days, every month, it's never going to become an orange fruit, let alone an orange tree, or never even an orchard. So we've come to the end of today's class. If you found any value whatsoever in today's class, please let me know in the comment section below. I read all your comments, I read all your suggestions, and if you have any recommendation whatsoever for future class, please leave the comment in the comment section below so I can review them accordingly. And if you found any value whatsoever in today's class, please give this video a thumbs up, a like, a share, and please subscribe. And until then, I'll see you in the next class. Bye bye. Love you.